On the evening news, a headline scrolls across the screen. National debt reaches record high. The anchor's voice explains that the government now spends more on interest than on defense or healthcare. Behind her, a digital chart glows with rising numbers that seem endless. In a quiet living room, a family watches the report while finishing dinner. The television light reflects softly on their faces. They listen without speaking, though the meaning feels heavy. They don't fully understand the numbers, but they know what they mean for them. Their mortgage payment increased again this month. Groceries cost more than last week. Even the electricity bill shows another small rise. On the coffee table, a few unopened envelopes lie scattered. One reads, "Credit card payment due." The total inside is higher than before. The father sets it aside, his eyes still fixed on the screen. The story on television isn't about distant politics or complex economics. It's about the rising weight that every family quietly feels. Across the country, similar scenes unfold every night. Couples review their budgets. Small business owners adjust their prices. Young workers check their pay stubs and realize they are earning less in real terms. Each of them carries a small piece of the same invisible burden. The national debt is not a number locked inside government buildings. It moves through every part of the economy, shaping prices, wages, and interest rates. It determines how far a paycheck stretches and how much tomorrow will cost. Most people never see it directly. They only feel its shadow, quietly spreading through their daily lives. For years, America has been borrowing to keep its promises. But promises built on borrowed money always carry a price. And sooner or later, that bill arrives. The question is not whether the nation can pay. The question is how long before the cost becomes too heavy to ignore. For decades, America has chosen to delay that answer. Each time the numbers grew uncomfortable, another loan seemed to make them disappear. Borrowing became the simplest way to solve every difficult question. But in the 1990s, the story was different. The economy was strong, optimism filled the air, and the government announced its first budget surplus in a generation. For a brief moment, it seemed possible to pay down the debt and begin a new era of discipline. Politicians spoke proudly about responsibility and restraint, but the celebration didn't last long. Soon came new tax cuts, new spending programs, and global crises that demanded quick responses. Each event added a few more zeros to the nation's balance sheet. At first, it felt harmless. Borrowing was easy, interest rates were low, and the world was willing to lend. The system learned that debt was not a warning sign. It was a tool. When emergencies struck, debt was the answer. When growth slowed, debt was the solution. And when confidence faltered, debt became the reassurance that money would keep flowing. It no longer mattered whether the balance sheet was rising. What mattered was keeping the machine running. In households across the country, people learned a similar habit. They used credit cards to fill the gap between income and expenses, never realizing that the nation was doing the same thing on a larger scale. Like a family that keeps borrowing to maintain its comfort, the country borrowed to maintain its image of endless prosperity. Over time, the distinction between necessity and convenience faded. Borrowing stopped being an emergency measure and became a way of life. Deficits turned into background noise, barely noticed amid daily debates. The numbers grew, but the sense of urgency disappeared. And with each passing year, the debt became not a crisis to fix, but a foundation to build upon. The problem with foundations built on debt is that they don't stay invisible forever. Sooner or later, the cracks begin to show. And when they do, the cost is never just financial. It reshapes economies, policies, and the future itself. The question now is what happens when the system that learned to borrow for everything finally reaches the limit of what it can owe. At first, it seems like nothing happens. The streets are still crowded. Stores open their doors. The skyline glows against the night, as if the city itself has no worries. But beneath that calm surface, something invisible begins to move. Each year, more of the nation's income is spent not on progress but on payment. Money that once built roads, schools, and hospitals now travels in circles, returning to the lenders instead of the people who earned it. It is the quietest kind of loss. No sirens, no collapse, only a slow withdrawal of strength from the system that holds everything together. Inside government buildings, the same pressure grows. Budgets tighten. Projects are delayed. A housing plan waits for funding. A research grant never leaves the proposal stage. Every new idea must now compete with the cost of the past. The numbers tell a simple story. This year, nearly $1 trillion will be spent on interest payments alone. That is more than the nation spends on defense or healthcare combined. It is the price of waiting too long to act. In households across the country, the pattern repeats on a smaller scale. Families pay their debts before saving for what comes next. Every paycheck feels shorter. Every bill feels heavier. People still go to work, still buy what they need, still live their lives. But the pressure that once lived only in national reports is now sitting quietly in their own homes. Economists describe it as fiscal drag. Most people simply call it fatigue. It's the feeling of running harder and getting nowhere, of paying more but owning less. That feeling is the soundless echo of debt spreading through an entire economy. The explosion doesn't come with a crash. It comes as a silence that deepens. It's in the rising cost of credit, in cautious investors, in the shrinking budgets that no one wants to discuss. And as that silence grows, the next stage begins to form. Because markets never stay silent forever, and when they finally respond, the reaction is rarely gentle. It starts quietly, like a change in the wind. Traders watch their screens, the numbers begin to move, and what felt stable yesterday starts to tremble. Confidence, once invisible, begins to leave the room. The government releases another report, promising stability, but markets don't wait for promises. They react to doubt. They move on instinct, faster than any speech or press conference can catch. In the space of hours, borrowing becomes more expensive, and the price of trust rises again. Bond yields climb as investors demand higher returns for greater risk. It is their way of saying they no longer believe what they're being told. Each small increase in rates ripples through the system. It reaches mortgage lenders, credit cards, and small business loans. The cost of money itself begins to rise. This is how markets fight back. Not with words, but with movement. Not with protests, but with prices. They withdraw their confidence like a tide pulling away from shore, leaving governments standing on exposed ground. In financial circles, some call them bond vigilantes. Investors who enforce discipline when politicians do not. They appear whenever debt grows faster than logic, whenever inflation lingers longer than patience allows. They punish not through laws or votes, but through rates and reactions. In the 1980s, this unseen force first earned its name. Back then, it was fear of inflation. Today, it's the fear of limits. The idea that even a nation as powerful as the United States can only borrow for so long before the markets decide otherwise. Around the world, traders and fund managers adjust their screens, moving billions with a click. Each decision is made in seconds, but together they form a storm. The charts turn red, the headlines follow, and the calm that once seemed certain begins to fade. The United States remains the center of the global economy, but the ground beneath it is no longer as firm. Other nations have begun to notice. Some watch in silence, others quietly prepare, adjusting their own positions as if sensing a distant shift in the air. Because when the largest market in the world begins to move, the rest of the world holds its breath. And as confidence continues to drift, a new kind of tension begins to rise far beyond Wall Street. The world is no longer watching with curiosity. It is watching with concern. From boardrooms to central banks, every conversation now includes the same question: what happens if America slows down? Trading floors hum with restrained energy. Screens glow in cities across time zones, each one reflecting the same unease that no one wants to admit. The world is paying attention. For decades, the United States has been the safe place for global money to rest. It was the anchor that kept other currencies steady, the foundation for trade, the measure of trust. But as its own debt grows, that trust begins to look less certain. The questions are no longer whispered. They are being calculated, modeled, and priced. Some countries begin to diversify their reserves, shifting small portions away from the dollar. Others adjust their lending policies, quietly preparing for a world where American stability is no longer taken for granted. Each move is cautious, but together they form a pattern. It is the kind of movement that happens before anyone dares to call it a change. Not long ago, another advanced economy tried to push through bold tax cuts and spending plans. Investors lost confidence overnight, and the value of its currency fell sharply. The government was forced to reverse its plans within weeks. No nation is immune to the loss of trust. Even the strongest balance sheet depends on what others believe about it. In global markets, belief is as powerful as numbers. A single headline can move billions of dollars before sunrise. A speech can shift interest rates before a vote ever takes place. And now, that belief, the quiet assumption that America will always be safe, is being tested. Foreign creditors begin to ask silent questions. How much debt is too much? How long can the world's largest borrower remain the world's most trusted lender? The answers will not come from Washington, but from the markets themselves. At international conferences, officials smile for the cameras, but their words are cautious. Behind closed doors, the conversation is different. They speak of hedging, diversification, and contingency plans. They do not say it out loud, but the thought is there. If the United States falters, the shock will not stop at its borders. Because when the foundation of the global system begins to shake, no country stands untouched. And as the world watches, the question is no longer about confidence. It is about preparation. In Washington, the lights stay on long after midnight. Inside the Capitol, committees meet, hearings stretch into the night, and speeches echo through nearly empty halls. The world waits for action, but what it sees instead is argument. Every proposal to fix the nation's debt faces a wall of division. One side demands spending cuts, the other calls for new taxes, and neither moves an inch. The debate has become its own ritual, repeated year after year, ending where it began. Each delay adds more weight to the problem no one wants to carry. Reporters gather outside the White House, their breath visible in the cold air. They speak about deadlines, shutdowns, and debt ceilings. Markets respond to every headline, rising and falling before any vote is cast. But inside the halls of power, the sense of urgency fades into routine. For ordinary Americans, the consequences are quieter but closer. A small business owner waits for a loan approval that never comes. A retired worker checks the news, wondering if government payments will arrive on time. Families see prices shift without understanding why. The gridlock in Washington is no longer distant. It reaches into homes, paychecks, and grocery bills. Economists call it policy paralysis. Citizens call it exhaustion, the sense that nothing changes, no matter how loud the warnings become. Meanwhile, the interest meter keeps running, faster each year, while lawmakers argue over the clock itself. The cost of inaction grows invisible, but it never disappears. Every day without a decision pushes the nation closer to the limits that markets have already sensed. And while the rest of the world prepares for what comes next, America's own government remains stuck between debate and denial. Soon, even allies will stop waiting for Washington to decide. Because in a world built on confidence, hesitation can look like weakness. And when hesitation lasts too long, others begin to move first. By the time Washington begins to act, the silence has already changed the landscape. Morning arrives like any other, but something feels different. Store shelves are stocked, but prices carry a quiet weight. Large companies trim their hiring plans, cautious of higher borrowing costs. At an office downtown, a manager rechecks next quarter's budget, realizing that yesterday's projections no longer hold. The economy still functions, but the rhythm has shifted. Across the country, investors grow defensive. Fewer startups receive funding. Corporations postpone expansion. The stock market moves in short bursts instead of steady climbs. Money itself has become more careful. It hesitates before taking risks, just as Washington once did. The government releases another fiscal update. Interest payments now consume a record share of revenue. Public infrastructure projects are quietly shelved, not with announcements, but with silence. Teachers wait for new textbooks that never arrive. City repairs are delayed, not canceled, just forgotten. It is how decline begins, not with collapse, but with slow neglect. In global markets, confidence no longer flows in one direction. Some nations strengthen regional partnerships. Others increase trade in their own currencies. For the first time in decades, the dollar's dominance faces quiet alternatives. None of it happens overnight, but history often shifts in silence. For ordinary Americans, the change is subtle yet constant. Insurance premiums rise, savings earn less, and college tuition outpaces wages. Dreams are still pursued, but with smaller steps. People adjust, not out of panic, but out of habit. The age of certainty is fading, replaced by one of careful calculation. Debt was never only about economics. It was about trust, the belief that tomorrow would always provide more than today. But trust, once stretched too far, becomes fragile. And now, as that belief thins, the country faces the same question it long postponed. What happens when the future finally demands to be repaid? The silence that once kept the system calm is breaking, and what replaces it is not chaos, but consequence. Because every generation learns, sooner or later, that the price of waiting is always paid in full.